We've been talking a lot about short-term insurance plans over the last 8 months. We're going to recap that conversation and get you caught up to current day. Short-term insurance plans were a thing of the past. They were before the Affordable Care Act, when folks were looking for just something to qualify as covering them, almost like catastrophic coverage, but it only lasted 3 months in duration. Then when the Affordable Care Act came around and people could get quality, affordable health insurance that was comprehensive, these 3-month short-term insurance plans kind of fell to the side and were only used in those instances when people needed that short-term insurance, that short gap coverage, if they had for something like a 3-month grace period to go without insurance and then still get something in the Affordable Care Act's marketplace. These short-term insurance plans did not have to comply with the Affordable Care Act's comprehensive coverage requirements. They did not have to cover pre-existing conditions, maternity care, newborn screening. They could be very bare bones, and for some people they were attractive because they were cheaper. But, of course, that comes with the cost of not offering all those covered services should you need them. Why are we talking about this now? Because we now have the resurgence of short-term insurance with a duration of not just 3 months, but a new rule that says they can last up to 1 year, just shy of 1 year, about 364 days to be exact. Now, this is something that was proposed first by President Trump in October of 2017 as an executive order. His order said, see what you can't do, federal agencies, to make it more possible for states to sell short-term insurance plans. What kind of regulations do we need? What does it look like for short-term insurance plans to become mainstream and to last longer than 3 months? A lot of negotiations happened at that time. That executive order didn't have much teeth to it. It was more of an investigative order, see what you can learn and then what we can put together. What they learned and put together then materialized in February of 2018 in the form of a proposed rule on short-term insurance. Now, the conversation during this time was not just on short-term insurance, but also association health plans. That conversation progressed in a similar way and is being handled by separate legislation and proposed rules. So we're talking just about the short-term insurance here. So after that February 2018 proposed rule, a public federal comment period opened where the public could weigh in, and they did. And there was a lot of negative comments from consumers and advocates and health policy experts saying this is not a good idea. There are a lot of risks when you offer short-term insurance plans for almost an entire year. First of all, they are attractive, so you will pull some healthier people out of the marketplace. But it comes at a huge risk of personal liability. Skimpier benefit requirements mean when somebody actually has to go to the doctor, they might be very surprised that their short-term insurance doesn't actually act like insurance and won't cover their needs. Now, we know from history that these short-term plans in the past only cover about half of a person's average medical costs. They left people with a huge personal liability for medical expenses. Now, like we already said, it can exclude things like maternity coverage, mental or behavioral health, and even prescription drugs. They also don't satisfy that individual mandate. Even being almost a year in duration, you're not meeting all of the requirements of the individual mandate, which means you don't get the consumer protections either. This has been said by a lot of health policy experts to divide the marketplace. Insurers get jittery because of this kind of unsettled marketplace, and plans have a history of leaving consumers with large medical bills, large medical debt. Other health policy experts are saying these plans, these skimpy plans, a lot of people call them junk insurance plans, are chipping away at the Affordable Care Act through the back door. Instead of repealing and replacing the Affordable Care Act, instead, the president and this administration is allowing junk plans to be sold and essentially do the same thing, pull people away from the Affordable Care Act into these skimpier plans. They are designed to attract the younger, healthier folks that might find a little bit lower premium attractive, although there are some health policy experts out there saying the cost really isn't that much cheaper if you do an apples-to-apples comparison. But then you leave your Affordable Care Act pools as the sicker, more expensive pools, which just means premiums keep going up in the Affordable Care Act marketplace. Now, again, it creates a less stable, less competitive individual market when you segregate people into these different risk pools and have a healthier risk pool off to the side. And it can be dangerous, especially in the context of everything else that's going on right now. And we're talking not just about the association health plans, like I mentioned, but the GOP tax bill, which gets rid of the penalty for not having insurance, and transitional health plans, the continuation of grandmother plans in the marketplace, which is, again, health plans that don't have to conform to the Affordable Care Act consumer protection policies. Now, there are reports that predict huge premium increases as a result of allowing short-term insurance plans to continue. And there are other predictions of what this actually might do to the rate of uninsured. As you make the Affordable Care Act more expensive and less affordable, you actually have people that just stop buying insurance altogether. There are two ways of thinking about this too. The people that drop Affordable Care Act or employers and sponsored insurance to buy a short-term plan are technically considered uninsured. They don't have that minimum essential health coverage or that qualifying minimum coverage that counts as being fully insured. So there were some projections that have come out recently about the number of uninsured from 2018 moving forward through 2023, and we'll look at that 2023 projection in just a second. But if we start looking forward from 2018, 2019, and then 10 years out, we're seeing an increase of 29 million people all the way up to 35 million people being uninsured. In Wisconsin, we have already seen our rate of uninsured start ticking right back up again after we had had a substantial decrease over the last few years. Now, I mentioned that 2023 year as a date to watch. The Congressional Budget Office put out a projection that by allowing short-term insurance plans and association health plans, we will see about 2 million people enroll in short-term insurance plans until up through 2023, the effective date of the change when it's supposed to be fully phased in. It'll be effective in the shorter term, working all the way up to a full implementation by the year 2023. An additional 4 million people joining association health plans at that same time. Now, the CBO, the Congressional Budget Office, is redefining insurance at the time it's giving these projections. So this is a little sidestep into some of the bureaucracy, if you may call it, of the way that these numbers are being released. So the proposed rule was distributed, people had a chance to comment, and then the Congressional Budget Office put out its projection of the cost and the impact of the short-term insurance proposed rule. In so doing, they keep changing their projected impact numbers. And part of the reason of how we could make sense of how they did this is very clearly in the way they just kept changing their definitions as they went. So before, under the previous administration, the number of people completely uninsured included people that bought junk plans, catastrophic plans that didn't meet the ACA minimum essential coverage standards, and plans that really, like association health plans and group plans that weren't counted in this individual market number. The Congressional Budget Office over the last few years, starting with December 2016, has slowly been broadening their definition of insurance so that when they give a projection of the impact of a piece of legislation or a rule, the number doesn't seem as extreme, which is just kind of shady. So the Congressional Budget Office, which used to be very trustworthy and very solid with its actuarial numbers and its accounting and its projections moving forward, has now been doing a little backdoor changing of definitions on it. So they're actually saying moving forward that health insurance definition is actually just, a financial protection against high-cost medical events. They broadened the definition very extreme, so it now covers a lot of the things that weren't previously covered. So now short-term insurance plans and association health plans are included in their number of covered Americans moving forward. So just a little side note that they had to change the definition of insurance to make it look like we're not losing as many people as we move forward. And while that's happening, a lot of states have started scratching their heads saying, you know what, the feds might be doing this. They might be chipping away at the Affordable Care Act through the back door. They might be trying to push people into junk insurance plans with less regulation and less consumer protection. But a few states have said, you know what, we're going to do it our own way. We're going to start working on some of our own legislation that restricts short-term insurance to a shorter duration. And a really good example is an advocacy group in the state of Illinois where advocates are pushing to restrict short-term insurance to a duration of 6 months, not getting rid of it entirely, but saying we don't have to agree to a full year. We can make this a little bit more restrictive. And this is the legislation that they're working on right now in the state of Illinois with a couple like-minded legislators. State of California went a little bit further and had legislation that they were working on a few months ago that would ban short-term insurance plans altogether. States do, if they're going to take their own route, they need to do so quickly because insurers are going to be setting their rates moving forward and people are going to start buying insurance soon for 2019. So we've got to have all of our ducks in a row in a hurry. Is that going to happen in all of these states? Probably not, but it's worth looking at to see what the alternatives are to what the federal government is working on. You can read the short-term insurance rule for yourself that the feds have put together. You can read a really informative health affairs blog post that goes through that Congressional Budget Office analysis and helps explain that ever-evolving definition of insurance, which makes it look like nobody's losing coverage when in fact people are losing their qualified minimum essential health coverage by joining a short-term or junk insurance plan. You could also read that Gallop Poll if you have a little bit more interest in what's going on in the state of Wisconsin or other states that have a similar trend in actually creating more uninsured in recent history. You can share your healthcare story or ask a question or send us an email, and you can do all of that at healthwatchwisconsin.org.